Happy Tuesday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. It is another big episode today, so let's jump in. In a dramatic escalation of trade tensions, US President Donald Trump announced on yesterday, that the United States would impose a massive 50% tariff increase on all Chinese imports unless Beijing withdraws its latest retaliatory tariffs by the 8th of April, today. If China fails to comply, Trump warned that, quote, all talks with China concerning their requested meetings with us will be terminated, end quote, adding fuel to an already volatile relationship between the world's two largest economies. In a fiery post on Truth Social, the US president accused China of, quote, record-setting tariffs, non-monetary tariffs, illegal subsidization of companies, and massive long-term currency manipulation. End quote. For regular viewers, many of these accusations may sound quite reasonable. He called Beijing's recent 34% retaliatory tariff hike, quote, a mistake on top of a mistake, end quote, and reaffirmed his stance that any further retaliation would be met with even more severe consequences. Quote, therefore, if China does not withdraw its 34% increase above their already long-term trading abuses by tomorrow, April the 8th, the United States will impose additional tariffs on China of 50% effective the 9th of April. End quote. If implemented, the cumulative tariffs on Chinese goods would soar to approximately 120%, a rate likely to make continued trade between the two nations, the world's two largest, virtually untenable. China's Ministry of Commerce responded swiftly, calling the US threats, quote, extortionate, end quote, and pledging to retaliate. Quote, if the US insists on its own way, China will fight to the end, end quote, the ministry said in a strongly worded statement. The currency, the yuan, weakened to its lowest point since 2023, while mainland Chinese stocks initially tumbled before rebounding on state-backed market interventions. We will cover this shortly. The deteriorating situation has prompted concerns among global economists and investors. Michelle Lam of Societe Generale warned of an imminent, quote, trade decoupling, end quote, between the two superpowers, while Bloomberg economists said the likelihood of aggressive Chinese stimulus measures is now higher than ever. Bloomberg chief economist Chang Shu expressed in a note, quote, the prospect of a heavy external blow to growth heightens the urgency to fast-track monetary and fiscal stimulus, end quote. In Song, ING chief economist for Greater China, observed today, quote, I don't think Beijing's going to back down. It might be a case of who blinks first. It feels more like a test of endurance at this point. Basically, who feels the pain first and who has to come to the table with a slightly weaker bargaining position to start with, end quote. Domestically, Chinese officials are reportedly preparing a suite of economic support measures, including boosting consumer spending, export subsidies, and a stabilization fund to shore up stock markets. General Secretary Xi Jinping has also vowed to shift China's economic growth model toward domestic consumption, aiming to reduce reliance on vulnerable export markets. Regular viewers will know, of course, that Chinese policymakers have been trying to do this for almost a decade and have accelerated efforts in the last 5 years, but still to no avail. Now, with their economic situation even more dire, it seems unlikely that this transition can be accelerated much more. Despite these measures, the threat of a full-blown trade war looms large. China's ambassador to the United States has attempted outreach, including through influential business figures like Elon Musk, but efforts to influence Trump's team appear unsuccessful. Quote, no one wants to serve as a go-between, end quote, a senior US executive told US-based Politico yesterday. The EU, meanwhile, is watching nervously. Facing a flood of Chinese exports, European leaders at Monday's Foreign Affairs Council emphasized the need to rebalance trade relations and counter China's industrial overcapacity. Quote, we need to push our very assertive trade policy, end quote, said France's trade minister, pointing to fears of collateral damage from a US-China showdown. With China still the US's largest trading partner, accounting for nearly 15% of total US imports in 2024, a tariff rate above 100% could devastate supply chains and significantly raise consumer prices in the United States. In saying this, however, the Chinese are far more vulnerable. They have a massive trade surplus with the United States, and last year sold almost $500 billion to the United States. Veteran China analyst Bill Bishop expressed on all of this today, quote, I do not think the PRC did scenario planning for 120% US tariffs. What in their toolbox can they use in response? assuming Xi does not just ignore this latest escalation. The choices do not seem great. Big RMB USD devaluation. Not sure they can devalue enough to matter, and they will end up angering lots of other countries they are trying to rally against the US. Targeting Apple, Tesla, or another major US firm could blow back on efforts to attract foreign investment. Impose tougher export controls on rare earths the US is especially reliant on may work for a while, but with resolve that bottleneck can be fixed. Much easier than the chip bottleneck to the PRC can be solved. Maybe a mass boycott of American products. They have not had one of these boycott campaigns in many years, and the sentiment is easy to unleash given the state of the relationship, though there are risks in ensuring it is channeled properly. But what else can they do? End quote. Shi Yinhong, a government advisor, professor at Renmin University in Beijing, and outspoken nationalist commentator, today said that while US-China trade stood to be, quote, mostly destroyed, end quote, Beijing's hardline approach was unlikely to change. He went on to warn, quote, China stands out as the only country in the world that has taken a uniquely tough and uncompromising position in response to Trump's tariff war, end quote, but admitting that the US president was correct in saying the old trade order greatly benefited China, expressing that this new trade reset would be, quote, extremely disadvantageous for China, end quote. On my other channel, Market Update, we discuss the tariff situation and its global ramifications in greater detail. Check that out if you'd like to explore this topic in greater detail. If you enjoyed today's episode of China Update, don't forget to like, subscribe if you want to be on top of these updates, these big updates as they continue in the following days and weeks. And also a quick piece of housekeeping. Tomorrow, Wednesday, there will not be an episode of China Update unless there is an emergency episode. As I said last week, going forward, China Update videos will be Monday, Tuesday, Thursday, Friday, and the occasional Saturday. Okay, with that said, let's continue. Mainland Chinese and Hong Kong stock markets plunged on Monday in one of their worst single-day performances in recent memory. Markets reopened after a Friday holiday, and much of the sharp sell-off was attributed to a combination of delayed reaction and escalating fears over a potential full economic decoupling between China and the United States, which we just covered. The Shanghai Composite Index sank as much as 9% before closing 7.34% lower, its steepest drop in 5 years. The CSI 300 Index lost 7.05%, while the Shenzhen market nosedived 9.66%, marking its worst day in over a decade. Hong Kong's Hang Seng Index fared even worse, tumbling 13.22%, the sharpest decline since the 1997 handover from the UK to China, amid what traders described as, quote, indiscriminate selling, end quote. Investor sentiment remained fragile despite commentary in the People's Daily, the party mouthpiece, urging confidence and a focus on domestic priorities in response to new US tariff threats. The late session recovery was sparked by intervention by China's so-called national team funds. Central Huijian Investment Limited and the other state-backed entities increased holdings of ETFs and central enterprise stocks, signaling their commitment to stabilizing the market. Analysts note that similar interventions in the past have often coincided with market bottoms, offering a potential floor to panicked investors. Chinese markets then rose on Tuesday after China's financial regulators and state fund managers vowed to support the country's stock market. Central Huijian, a unit of the country's sovereign wealth fund, said it has, quote, ample liquidity and smooth funding channels, end quote, to play its role of, quote, market stabilizer, end quote. While the People's Bank of China followed with a statement saying it could support Central Huijian's liquidity with refinancing tools. That is to say, the state is buying up the stock market to stabilize prices. In a separate notice, China's National Financial Regulatory Administration said it would increase the proportion of insurance funds invested in the stock market. When trading opened on Tuesday morning, the Hang Seng jumped 3%, led higher by the Chinese companies listed in the territory, while the mainland's CSI 300 rose 0.3%. Next up, today, Tuesday, Chinese financial media outlet Caixin published a long, in-depth report called China's Export Machine Stalls Under Trump's New Trade Blitz. The piece, written by 10 Chinese analysts and experts, gives a sobering look into how this trade war will affect Chinese manufacturing. We will end today's video by unpacking some of it. The authors argue that the tariff announcement sent shockwaves through Chinese manufacturing hubs. Quote, "When I woke up, my entire WeChat feed was filled with tariff news," end quote, said Jerson Wong, head of a lingerie company in Shantou, Guangdong province, one of China's largest apparel export centers. Wong, whose business relies on the US for 40% of its sales, said American buyers are pulling back sharply, with some indicating plans to cut sourcing from China to zero. Industries hit hardest are those already squeezed by rising labor costs and previous trade rounds. Apparel, furniture, footwear, toys, and other labor-intensive sectors. Many face total effective tariffs of up to 79%, and this was before the extra 50% threatened by the United States President yesterday. Even at 79%, these are levels that threaten the viability of exporters operating on slim 10% to 15% margins. With traditional exports under siege, Chinese manufacturers had increasingly embraced direct-to-consumer e-commerce, but Trump's move to eliminate exemptions for small parcels used in over 1.3 billion shipments in 2024 is dismantling that fallback. Now, fees of $25 to $50 per package plus 30% tariffs will cripple many small sellers. Quote, "For small sellers like me, it's a devastating blow," end quote, said one Amazon merchant who specializes in customized goods. Major platforms like Shein, Temu, and TikTok Shop, which built their US dominance on small, fast, direct shipping, are also under pressure. Shein, for example, relies on shipping small batches based on digital trends, allowing rapid inventory adjustments. New rules may force a pivot to warehouse-based models, increasing costs and slowing flexibility. In parallel, hopes of shifting production to Southeast Asia are dimming. Cambodia and Vietnam, key nodes in China's offshore production web, now face tariffs of up to 49%, including on solar products, textiles, and electronics. Some companies, such as Wong's, have frozen planned investments in countries like Vietnam, as the math no longer adds up. Quote, "If tariffs are just as high in Vietnam, what's the point of moving there?" End quote. Chinese solar manufacturers are also in crisis. The US Commerce Department's decision to impose tariffs on solar cells from Cambodia, Vietnam, Malaysia, and Thailand has stalled production, shrinking Southeast Asia's share of US solar panel imports from 82% to 55%. Some producers are now relocating to Indonesia, Laos, and the Middle East, where new tariffs are relatively lower, though infrastructure and capacity remain limited. Meanwhile, the tariff blow is reverberating across China's industrial belts, especially in Guangdong, Fujian, Shanghai, and Qingdao, which produce significant shares of global goods like toys, furniture, and clothing. In Shanghai, Shantou alone, factories make 50% of China's plastic toys and a third of the global supply. With few alternatives, exporters are eyeing Europe, Russia, and Latin America, but each market has its challenges. Payment risks in Russia, stiff competition in Southeast Asia, and weak infrastructure in Latin America. Some manufacturers are exploring a workaround, routing goods to the US via Mexico and Peru, leveraging new express shipping routes and recently opened Chinese-operated ports in the region. Trade experts warn that Trump's tariffs are upending global supply chains, forcing companies to re-evaluate sourcing, manufacturing, and distribution strategies. Chinese firms acknowledge that surviving this wave of tariffs requires a fundamental upgrade in capabilities. Quote, "We can't just keep competing on price," end quote, said Wong, with the United States still accounting for nearly 15% of China's exports, worth over $520 billion in 2024, over $500 billion. Walking away isn't an option, but continuing under current conditions may not be either. For many manufacturers in China, Trump's latest tariffs are not just a policy shift, they are a tipping point, and if they stay in place, we are likely seeing the end of Made in China. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Tuesday, and unless there is need for an emergency episode, I will see you all on Thursday.